Everyone is waiting for mortgage rates to come down. The logic feels obvious. Inflation cools, central banks cut rates, mortgage rates follow. That's how it used to work. Think of it like a bridge. On one side is the central bank, on the other side is your mortgage. For decades, when central banks moved, the bridge held. The signal crossed cleanly. Mortgage rates followed. But today, that bridge is broken. There's a gap in the middle, and that gap is the 10-year yield. Even if central banks start walking, the message never reaches the other side. And the reason isn't policy, it's structural. Governments want to issue more long-term debt. It's safer for fiscal planning, reduces rollover risk, and becomes unavoidable as spending rises on defense and security. That part makes sense. What's changed, quietly, is who is willing to buy that debt. For decades, pension funds were the backbone of demand for long-dated bonds. They were guaranteed buyers because they had guaranteed obligations. That world is disappearing. Look at the Netherlands. They're dismantling one of the largest pension systems on Earth, moving from guaranteed checks to individual pots. This is a massive de-risking event. When a fund isn't forced to pay a 90-year-old for the rest of their life, it doesn't need to buy a 30-year bond. It would rather buy stocks or short-term cash. The natural buyer of long-term debt is retiring. And what replaces it? The old guard was simple: one massive fund buying billions in 30-year bonds and locking them away for decades. The new world looks very different. Millions of individuals checking apps, chasing 5% in money markets, ready to sell the moment volatility hits. The market didn't just lose size, it lost patience. This is where the hidden cost appears. Investors are now demanding a term premium, an extra payment just for the risk of time. In the old world, time was cheap. Pensions absorbed the risk. In the new world, time is expensive, so long-dated bond prices fall. Long-term yields stay high. This creates a steepening curve. The front end, controlled by central banks, goes down. The back end, controlled by the market, stays up. For homeowners, this is a trap. You're waiting for rescue from central bank rate cuts, but the bond market won't allow the signal to pass through. Mortgage rates don't price off policy headlines. They price off bond auctions. Now, some people will say, but the stock market is doing great. And that's exactly the point. The stock market reflects the top of the economy, not the whole economy. Large corporations are cash-rich. They borrow short-term. They don't need 20 or 30-year money to survive. Rate cuts help them immediately. But this is a K-shaped reality. Below the surface, small and mid-sized businesses live in a very different world. They don't issue commercial paper. They rely on banks and long-term loans to buy equipment, build factories, and expand. And those loans are priced off the same broken long end of the curve. So even as central banks cut, their borrowing costs stay high. This is where the real damage happens. When time was cheap, a business could say, "We'll build this factory. It pays off in 15 or 20 years." Now the math has changed. If a project doesn't pay for itself in 5 years, the interest alone can kill it. Not because it's a bad idea, but because time itself has become a luxury item. And then comes the checkmate. Governments are flooding the market with long-term debt. Pension funds are stepping away. That means governments are now competing directly with businesses for the same pool of private capital. When a government, the risk-free borrower, offers higher yields, businesses have to offer even more just to compete. This crowds out private investment, so stocks can rise, margins can improve, buybacks can increase, all while future growth quietly stalls. This isn't a policy mistake, it's structural. We're entering the era of the uncoupled rate. Don't watch central bank speeches. Watch who shows up, or doesn't, at long-term bond auctions. That's where mortgage rates are set. That's where capex decisions are killed or greenlit. And that's where the next economic slowdown will quietly begin. This is Global Notes by JP. If you found this helpful, comment, like, share, and hit the bell. We're building the strongest macro community on the platform, one signal at a time, together.